These are all of O-Levels Economics Section 6 definitions in 3 minutes. Tariff is a tax on imports. Globalization is the process by which the world is becoming increasingly interconnected through trade and other links. Quota is a limit placed on imports or exports. Embargo is a ban on imports or exports. Exchange control is a limit on the amount of foreign currency that can be obtained. Voluntary export restraints are agreements with other governments to restrict their exports to the country. Infant industries are new industries with relatively low output and high costs. Declining industries are old industries that are going out of business. Strategic industries are industries that are considered important for the survival or development of the country. Dumping is the practice of selling products in a foreign market at a price below the cost of production. Foreign exchange rate is the price of one currency in terms of another currency or currencies. Fixed exchange rate is an exchange rate whose value is set at a particular level in terms of another currency or currencies. Devaluation is a fall in the value of a fixed exchange rate. Revaluation is a rise in the value of a fixed exchange rate. Floating exchange rate is an exchange rate that can change frequently because it is determined by market forces. Appreciation is a rise in the value of a floating exchange rate. Depreciation is a fall in the value of a floating exchange rate. Foreign direct investment involves setting up production units or buying existing production units in another country. Hot money flows are the movements of money around the world to take advantage of differences in interest rates and exchange rates. Trade in goods is the value of exported goods and the value of imported goods. Trade in goods deficit occurs when expenditure on imported goods exceeds revenue from exported goods. Trade in goods surplus occurs when revenue from exported goods exceeds expenditure on imports. Trade in services is the value of exported services and the value of imported services. Trade in services surplus occurs when revenue from exported services exceeds expenditure on imported services. Primary income is income earned by people working in different countries, and investment income that comes into and goes out of the country. Secondary income consists of transfers of money, goods, or services between residents and non-residents that are not made in return for anything else. Current account balance is a record of the income received and expenditure made by a country in its dealings with other countries. Thanks for watching.